this video we will learn about income tax. Points of presentation: introduction, brief history of income, heads of income, important terms, income tax rates, exemption and deductions, some useful tips, conclusion. Taxation is the price which civilized communities pay for the opportunity of remaining civilized. Brief history of income tax in India. In this world nothing can be said to be certain, except death and taxes. Benjamin Franklin: tax is a mandatory liability for every citizen of the country. There are two types of tax in India, i.e. direct and indirect. Taxation in India is rooted from the period of Manu Smriti and Arthashastra. Present Indian tax system is based on this ancient tax system, which was based on the theory of maximum soak. Brief history of income tax in India. In India, this tax was introduced for the first time in 1860 by Sir James Wilson in order to meet the losses sustained by the government on account of the military mutiny of 1857. In 1918, a new income tax was passed and again it was replaced by another new act which was passed in 1922. This act remained in force up to the assessment year 1961-62 with numerous amendments. In consultation with the Ministry of Law, finally the Income Tax Act, 1961 was passed. The Income Tax Act 1961 has been brought into force with the 1st of April 1962. It applies to the whole of India and Sikkim, including Jammu and Kashmir. Since 1962, several amendments of far-reaching nature have been made in the Income Tax Act by the Union Budget every year. Income tax authorities: central government, income tax, excise duty and customs duty. State government, sales tax, VAT, excise and tax on agricultural income. Municipalities, octroi and house property tax. What government do from our tax? The government provide health care through government hospitals. Usually they offer service without any cost. Education: in municipal and government schools the fee is negligible. The government also provides cooking gas at concessional rate or gives subsidy. Of course, the major expenditure of government has to be incurred on national defense, infrastructure developments etc. Taxes are used by the government for carrying out various welfare schemes including employment programs. There are lakhs of employees in various departments and the administrative cost has to be borne by the government. Though the judicial process involves delay, yet the salaries, perks of judges, magistrates and judicial staff has also to be paid by the government. Thus, on considering these various duties of the government, we need to appreciate that we must pay tax as per law. We have to act like a responsible citizen. Some important definitions: income. Income means some monetary returns periodically received from some definite source. Assessors: a person liable to pay any tax or any other sum of money under this act. Person: according to law, an assess is a person by whom any tax is payable. Person includes an individual, a firm, a half, a local authority, a company. Assessment years: it is a year in which the income of the previous year is to be assessed. The current assessment year is 2023-24. Previous year means financial year immediately preceding the assessment year. Previous year for this assessment year would be 2022-23. What are ITR forms? ITR is a prescribed form through which you communicate the details of your income earned, deductions claimed, and taxes paid in a financial year to the Income Tax Department. It also allows you to carry forward the losses and claim a refund from the Income Tax Department. Different ITR forms are prescribed for different categories of taxpayers: individual, half, company, LLP, partnership firms etc. The department has notified 7 various forms, i.e. ITR1, ITR2, ITR3, ITR4, ITR5, ITR6 and ITR7 till date. The selection will depend upon taxpayer's status, nature of income, residential status in India, etc. Which type of ITR? ITR 1, resident individual having income 50 lakh form, salary, pension, other sources 1, house property. ITR 2, income form, every income form. ITR 1, lesser 50 lakhs, capital gains more than 1, house property, foreign income. Foreign asset holding directorship in a company holding unlisted equity shares. Item 3 income form. Every income form. Item -2 business profession is a partner in a firm. Presumptive income less than 50 lakh. Item 4 every income form. Item -1 presumptive income under salary, pension, other sources. 1 house property. Total income less than 50 lakh. Item 5 applicable to firms, LLC, ofs, boys. Item 6 companies not claiming exemption under section 11. Item 7 persons, companies under section 139 4A, section 139 4B, section 139 4C, section 139 4D. Heads of income. Income from salary, income from house property, income from business profession, income from capital gains, income from other sources. What is income tax slab? Indian income tax levies tax on individual taxpayers on the basis of a slab system. Slab system means different tax rates are prescribed for different ranges of income. It means the tax rates keep increasing with an increase in the income of the taxpayer. This type of taxation enables progressive and fair tax systems in the country. Such income tax slabs tend to undergo a change during every budget. These slab rates are different for different categories of taxpayers. Income tax has classified 3 categories of individual taxpayers, such as individuals aged less than of 60 years, including residents and non-residents, resident senior citizens 60 to 80 years of age, resident super senior citizens aged more than 80 years. Income tax slab rate for free 2022-23, AY 2023-24, new tax regime. Why is it optional? In this new regime, taxpayers has an option to choose either to pay income tax at lower rates as per new tax regime on the condition that they forego certain permissible exemptions and deductions available under income tax, or to continue to pay taxes under the existing tax rates. The assessee can avail rebates and exemptions by staying in the old regime and paying tax at the existing higher rate. Income tax slab rate free 2022-23, AY 2023-24, applicable for new tax regime. What are income tax deductions? Income tax, deductions aid the individuals mitigate their tax liability in a specific financial year, FY. This implies that the investments that are made in a free offset against the gross yearly income when you file your IT return are called income tax deductions. This provision was brought into effect in order to inculcate a savings habit amongst people and help them construct a monetary future which is stable. Few examples of income tax, deductions are National Pension Scheme, NPS, Public Provident Fund, PPF, investments done U.S. 80 of the Income Tax Act, ETA, 1961, in equity-linked savings scheme funds, etc. Benefits of tax deductions. Tax deductions have several advantages to offer. They are: tax deductions help you mitigate a sum from your taxable salary income and save the tax. If the tax on your income is reduced, it helps you develop a savings habit and invest your money in several other areas. Income tax deductions mitigate the income subject to the maximum tax brackets. Hence, you will be able to claim the deduction for the sum spent in medical expenses, tuition fees, and charitable expenses. Income tax return, is necessary, i.e., it is impossible to avoid the payment of tax completely. However, you can definitely mitigate your taxable income through proper planning. Several types of income tax deductions in India: Public Provident Fund, PPF, life insurance premiums, National Savings Certificate, NSC bank fixed deposits, FDs. Senior Citizen Savings Scheme, SCSS Post Office Time Deposit, POTD Unit Linked Insurance Plans, ULIP, Home Loan MS Mutual Funds and ELSS Stamp Duty and Registration Retirement Savings Plan, Tuition Fees, Medical Insurance Premiums, Infrastructure Bonds, Deduction on House Rent Paid. Income tax deduction under Section 80. Several income tax deductions can be claimed by taxpayers U.S. 80 of the IT Act, 1961. Below mentioned table will give you a visual understanding of the various income tax deduction limits and whether you are eligible to claim them or not. Describe Section 80DD to Section 80U. Here we know how to file it. Process of filling. Thank you for learning this video from options and ideas.